All right, today we're going to do something cool. We're going to step inside the mind of a value investor and really break down their analysis of a huge company, Kinder Morgan. We'll see how they go from the basics of the business all the way down to figuring out what it's actually worth.
But let's start with a big question, a really specific one. Could you earn 9% a year every single year for the next 16 years on just one investment? I mean, think about that. That's the goal this whole analysis is built around. So the real question is, can Kinder Morgan be the stock to get you there? Well, we're about to find out.
So let's talk about Kinder Morgan. What do they even do? The easiest way to wrap your head around it is to think of them as a giant energy toll road. Seriously, it's a perfect analogy, and it really explains their whole business model in a nutshell.
Okay, so here's how we're going to tackle this. First, we'll dig into that whole toll road idea. Then we'll crunch the numbers to find its true value. After that, we'll do a deep dive diagnosis. Look at the good, the bad, and the ugly. Figure out what the right price to pay is, and wrap it all up with the investor's final call. All right, first things first. Let's really get into how this energy toll road operates. How does Kinder Morgan actually make its money? Because understanding this is crucial for everything else we're about to talk about.
Their business is actually pretty straightforward and built to last. They own this massive web of pipelines, right? And other companies pay them a fee to move stuff like natural gas, gasoline, even CO2 through those pipes. It's exactly like paying a toll to drive on a highway. And here's the key thing you have to remember. Their revenue is based on these fees, which are locked in with long-term contracts. This is huge. It means they don't really care if the price of oil is up or down. All that matters to them is that the volume keeps flowing.
Okay, so we've got this stable, predictable toll road business. That sounds pretty good, right? Well, now we get to the heart of the matter for any value investor. It's time to pit the market against the math. We need to figure out what the company is really worth, and then see how that stacks up against its current price tag.
And here it is, the big reveal. When this analysis was done, the stock market was selling shares of Kinder Morgan for $29.59. But after the analyst crunched all the numbers, did the homework, the calculated intrinsic value, its true worth, was only $24.25. Whoa, that is not a small difference.
Yeah, that's a downside of more than 18%. So what does that mean in plain English? It means the stock is being sold for way more than the business is actually worth. And for a value investor, that's like a giant flashing red light. It's an immediate red flag. And the analysis really nails it with this quote. The stock is trading at a premium, and because of that, there's no margin of safety. Now, that's a super important idea for value investors. Think of it like a safety net. It's the cushion between the price you pay and what you think it's worth, just in case you're wrong about a few things. And in this case, that safety net, it's gone. It just isn't there.
So the big question is, why? Why is there such a gap between the market price and the real value? Well, to figure that out, we've got to pop the hood and take a look at the engine. It's time for a deep dive diagnosis of the company's financial health.
And we're going to zero in on one really important number. It's called return on invested capital, or ROIC. It sounds complicated, but it's not. It's basically a report card for how well the company uses its money. The question it answers is simple. For every single dollar the company puts into the business, how much profit does it get back? And right here, this is where we find what the analyst calls the company's central weakness. Check this out. Kinder Morgan's ROIC is only 4.4%. Now, here's the problem. The money it uses to run the business and to grow, its capital, well, that costs them between 8 and 9%. So think about that. It's like they're borrowing money at 8 or 9% interest, but they're only earning 4.4% on it. They're losing money on their investments. That is the exact opposite of what you want. Instead of creating value, they're actually destroying it. And there's another piece to this puzzle. Free cash flow. That's the real cash the company has left over at the end of the day. And yeah, it's stable, but look closer. It's also going down. Over the last year, it was about $2.76 billion. But that's a pretty big drop from its 5-year average of almost $3.6 billion. It's just another warning light on the dashboard, suggesting that the engine isn't quite running right.
Okay, so we've diagnosed the problem. Now let's zoom out a bit and look at the bigger picture. What are the strengths, the weaknesses, and what are the different ways the future could play out for Kinder Morgan?
So this SWOT analysis, strengths, weaknesses, opportunities, and threats, it gives us a really balanced view. The strengths, that stable toll road business, they get a pretty good score, a 7 out of 10. But the weaknesses, like that poor return on capital we just talked about, they're not far behind with a 6. So when you add it all up, you get a score of 6.1. What does that tell us? It says Kinder Morgan is fine. It's a solid company, but it's not exactly knocking it out of the park.
And that just fine picture leads us here to the different scenarios. If things go badly, the bear case, the stock might only be worth $18. The base case, our most likely scenario, is that $24 value we've been talking about. But here's the kicker. Even in the super optimistic bull case where everything goes right, the value only gets to about $30. And wait a minute, that's basically where the stock is already trading today.
So this all leads to the million-dollar question, right? If you're an investor and you want to hit that 9% return goal we started with, what price should you actually pay for this stock? This is where value investing gets really practical, and frankly, where the discipline comes in. Look at this. If you're cool with making just 5% a year, you could buy the stock for around $27. But remember our mission? We're aiming for 9% a year. And to get that, the math is crystal clear. You cannot pay a penny over $18.80. That is a world away from where the stock is trading right now.
And you might think, well, what if I don't hold it for 16 years? Well, take a look. Even if you only want to hold for 5 years, you'd still need to buy in around $23 to hit that 9% goal. The lesson here is simple. The longer your time horizon, the more patient and disciplined you have to be about the price you pay.
Okay, we've looked at the business, we've crunched the numbers, we've found the problems, and we've figured out our price. So, where does that leave us? What's the final verdict? To buy, to sell, or to wait?
Honestly, this quote from the analyst says it all perfectly. A solid business, but an uninspiring investment at today's price. I mean, that just hits the nail on the head, doesn't it?
So let's recap the big takeaways here. First, Kinder Morgan is an income stock. It'll pay you a dividend, but it's not a growth machine that's going to compound your money into a fortune. Second, the current stock price, well, it's already priced for perfection. All that stability is baked in, so there's no margin of safety. Third, if you want that 9% return, you got to wait for the price to drop below $19. So the final verdict from this analysis is pretty clear. If you own it, maybe think about selling. And if you don't, you wait. You wait for a much better price.
And that leaves us with one last thing to chew on. Right now, the market is crazy volatile, and a lot of people are willing to pay a high price for a safe and predictable company like Kinder Morgan. But it makes you wonder, is that stability really worth it if it comes at the cost of actual growth? Is predictability the ultimate prize, even if you have to overpay for it? That's a great question to ask yourself. Thanks for tuning in.